what part is face value, what part is additional, above face value. Difference between issue price and face value. Okay, so let's take a look at the first case. Let's say we're issuing stock, and now at the beginning, the face value and the issue price coincidentally is the same. Okay, face value of the stock for each and every stock is $1, and we're also issuing this stock at $1. Okay, now let's say the issuance of the stock, the number is 1 million stocks. So after issuing 1 million stocks, corporation, again, the goal for issuing stock is getting capital in. Okay, one way to get capital is by selling your items, by providing services to customers. Another way is by issuing stock for public traded companies. So once they issue this $1 million of stock, if it's at $1, the market price right now is at $1, so they're getting cash $1 million debited. Credit side will increase their equity, common stock. Okay, so this is issuing common stock at the par value. Par value equals to face value. Okay, so par and face refers to the same, basically the minimum amount for the stock. So this is the case that there's no difference between par value and issue price. You just debit cash for whatever the money that you receive and credit common stock. Just to refresh your memory a little bit, equity falls under the right-hand side of the accounting equation. Remember, asset equals liability plus equity. Liability and equity, both of them, the normal balance side is the right-hand side. So you almost will never see common stock be debited because we're raising capital. Okay, for all the cases that you see, oftentimes common stock will be on the credit side because we're increasing capital, collecting cash, and at the same time, while we collect cash, the left-hand side of the equation, asset will increase, right-hand side equity, common stock will increase. Okay, if we move on to the second case, let's say now we're not issuing at the par value, but at a dollar amount above the par value. So again, issue price may be different from face value of the stock. Face value is just an arbitrary amount that company designate to the stock. So oftentimes it's at a very minimum level. Now if, again, the face value of the stock is just $1, but the issue price right now in the market for the company per share is $20, then for each and every share that company issues, there is a difference, $19. Okay, so if you know the difference here, we just need to know then how many shares are we actually issuing out to the public. If we're issuing, again, 1 million shares, the difference is 19, then we separate this part that's above par value to another account, paid in capital in excess of par. So if we post this information to T account, you will have $1 million under common stock still, the same as the first entry because face value is still $1 times 1 million shares. For paid in capital in excess of par, you have $19 million here on the right-hand side. So that will be the difference between face issue price and face value, and again, times the number of shares. So this T account will have right-hand side common stock increase $1 million, right-hand side paid in capital in excess of par increase $19 million. Now the debit side for cash part here is always the market price or the issue price times the number of shares. Okay, the first example is that the market price is the same as par, so it's $1, you're collecting $1 million. Second example, the issue price, market price is $20. You're issuing 1 million shares, for example, then you're getting $20 million. On the right-hand side, we want to separate what part is the face value, what part is the part above face value. So this part that is above, oftentimes is also called issuing common stock at a premium. Okay, premium means a dollar amount above the par value. Now, unlike bonds, for common stock, we would not have a discount. Okay, if the market price goes below $1, basically companies are prohibited to issue additional stock because this is for the protection, basically to protect creditors. Because all these equity, if it's going below the original face value, then later on, perhaps company will not even have enough fund to pay interest to the people that they borrow money from. So we will only see premium cases. There's no discount to this. You pretty much only see either issuing at the face value, that is already the minimum amount, or above the face value. You would not have a discount for common stock.